Hello, I'm Ryan Lightfoot Aminoff of Chelsea Financial Services, and today I'm joined by Ken Wotton, the manager of the Gresham House UK Multi-Cap Income Fund, which sits on Chelsea's selection. Ken, thank you very much for your time today.
Hi, Ryan. Thank you.
Now, as the name of the fund suggests, you can invest across the market spectrum, and you currently got about a third of the portfolio in AIM stocks and up to sort of a third in FTSE 250. Perhaps you could talk through each part of the market. What's the opportunity set looking like in each of those areas?
Sure. So our multi-cap income fund has the flexibility, as the name suggests, to invest right across the market cap spectrum. So we try to go where we think the best opportunities are, and regardless of size, and that's really about trying to deliver a total return proposition to our investors, high single-digit total return, and currently targeting about 4% yield as part of that. So we think there's lots of opportunities right across, from very small companies through to the FTSE 100 in terms of kind of delivering, I guess, returns which blended together will provide us with that output for investors. And really isn't the case that you see high yielding opportunities in sort of bigger, boring FTSE 100 companies and sort of more racy growth stocks giving capital growth at the smaller end or on AIM. Really, there's you can get very small companies that have very stable, attractive, high dividend yields because of their dominant position in their niche, and you can get some interesting larger businesses with some sort of quite exciting capital growth prospects. So, and I think the environment following the impact of COVID and the discontinuity in the market last year has actually meant, probably more so than for a number of years, that there are actually interesting opportunities right across the market cap spectrum. So at the moment, the fund is positioned just under 40% of its NAV is in companies in the FTSE 350. Finding more interesting opportunities in the 250 really, and then the rest in small and mid cap. And we're agnostic as to whether we have companies that are listed on AIM or whether they're on the main market. We really focus on the individual company and its own characteristics rather than the specific market that it's listed on. So I'm not sure if that answers your question, but we have definitely found some interesting opportunities in that FTSE 250 space, particularly around businesses that a good example would be Premier Foods, which has been a very unloved stock for a number of years, probably, and been saddled with excessive debt really since the financial crisis in 2008, and it's been through an extended turnaround period. But actually, we've looked at it again. Probably many investors wouldn't really have been looking at it, particularly for an income perspective. But we think that the turnaround is now sort of largely played out. The debt's come down, the pension deficit sorted, and actually the company's just recently sort of announced that it's coming back onto the dividend list. And whilst the dividend yield is relatively modest initially, we can see good scope for it to grow to sort of towards our target over the next 2 or 3 years.
That's interesting. Thank you. You said you've got sort of a 4% yield on the funds. It's not bad in the current low yield environment, but really good. And you consider how tough a year it's been for dividend investors. How has it recovered on the fund after what's gone on in the last year and a half?
Well, because of the way that we positioned the fund, actually our dividends last year were certainly on a relative basis quite resilient. So we saw dividend per unit on the fund fall by about 17% during 2020, which sounds a lot, but that compares to the overall UK market dividend falling sort of by around half. So we outperformed in terms of kind of how our dividends from our portfolio companies fared relative to the overall market. And that's partly that's because we avoid certain sectors which are particularly badly hit, like banks and oil and gas and mining. But also because our process really focuses on niche businesses that are resilient, that have good profitability, good cash flow, low debt, and therefore have the sort of earnings and cash coverage to pay attractive dividends, and they didn't have to cut to the same extent. And even the ones which did cut last year, they really most of them were cutting due to prudence because of the uncertainty in sort of Q2 last year when no one quite knew what was going to happen. And most of those businesses sort of reinstated their dividends in Q3, Q4, and some of them even paid catch-up dividends. So we actually saw, for example, in Q3 last year, we saw our dividends increase materially year on year when the market was still down almost 50%. So I think in terms of the recovery, clearly we don't expect, because we didn't fall as much, we don't expect on a percentage basis as big a recovery as the market is likely to see, with some of those sectors that are starting to reinstate dividends. But if you look at the Link report, the dividend monitor report they put out quarterly, they're not anticipating that UK dividends will recover to where they were in 2019 until 2025. So there's going to be a pretty sort of slow, painful rebuild. We're expecting our dividends to grow sort of mid double digit percentage this year on year. Last year we delivered a 3.3% yield. This year we're targeting 4%. So we'll see good recovery, but probably slightly lagging in percentage terms of the market.
Yeah, and you sort of brought out some of the wider issues there, and fortunately you've navigated extremely well. But it has led to issues with investors, and they've taken lots of money out of UK equity income funds recently. Why would you say an investor should still consider the asset class in their portfolio?
Well, I think ultimately the income sector is catering for a fundamental requirement of investors, which is that they want income from their investments, particularly in retirement. So I think the sector is specifically set up for that. Over recent years, when sort of technology and growth stocks have been performing extremely strongly, there's been a shift to people actually effectively taking income out of their capital, and sort of the rise of platforms has enabled that to sort of happen more easily. But I guess firstly, genuine income paying stocks are sort of a more stable and more resilient way of providing that income for investors, and doesn't rely on sort of the bull market we've seen over the last 10 years to continue indefinitely. And then the second thing is that, from my perspective, income paying stocks, or businesses that pay dividends, are fundamentally, they need to generate cash to be able to do that. And that's, and from a sort of fundamentals perspective, which is what we really focus on, those are businesses which are have long-term prospects, that have good market positions, that generate good profits. That profit turns into cash, and that cash can be used to pay dividends. So I just think from a risk perspective, you're more underpinned.
Maybe just to bring it to life a little bit, can we talk about a couple of examples in the portfolio? Firstly, a name that's a little bit under the radar, probably to most of our listeners, Duke Royalty. Can you just explain what the firm is, what it does, and why exactly you like it?
Yeah, so Duke Royalty, it is quite a niche business. It's a royalty finance business, so it effectively provides funding to typically SME and sort of mid-sized businesses that effectively securitizing their future proportion of their future revenues. So it tries to find the businesses that may not be able to secure bank finance, or they don't like the sort of the risks attached to just typical bank finance, where they've got covenants, etc. And they can find a funding solution which is more flexible, particularly where there's potential ups and downs or uncertainty about how the revenue is going to pan out, because it's linked to the revenues they generate. So it's kind of interesting niche sort of funding source for businesses. It's not very well known in the UK and Europe, but it's pretty mainstream in North America. And some of the people who are involved in Duke Royalty have sort of cut their teeth in businesses doing similar things at larger scale in North America, and particularly in Canada. So we think it's a kind of interesting niche business which is growing, and awareness about what they do is increasing. And from an investment perspective, they are focusing on a diversified group of high quality revenue generating and cash generating businesses. And the whole business has been set up specifically to deliver a quarterly dividend yield to its investors. So that's part of the kind of strategic objectives of the business. So we think it's from perspective of our multi-cap income fund, it's a small cap company. It's a bit under the radar, as you said, but the cash and return characteristics are really attractive. And as they grow their businesses and some of those underlying portfolio companies perform well, then there's obviously opportunity for capital growth as well.
And then perhaps sort of slightly differently, a company, if you watch any adverts, you can't really escape money supermarkets. What makes that such an attractive investment in your view?
So we tracked Money Supermarket for a number of years. It was a FTSE 250 company, and when we entered 2020 and the market sort of had the big sell off at sort of February, March time, actually suddenly the business got to a valuation which we hadn't really seen for quite some time, having monitored it. We had pretty good insight, particularly around quality of the people, the management team, the succession planning around the CEO, because one of our advisory board members used to be the chairman of Money Supermarket for a number of years. So we had good insight into the strategy and people, which is sort of a key part of our due diligence. And then in terms of the company's positioning, you're right. You see them on the TV adverts along with many of their competitors. And I think the way that we look at it is this is a business with a strong market position in a particular niche market. It has a business model which is high margin, and it's inherently a very cash generative business. It has a net cash balance sheet, so we felt that even though some parts of its business were going to be impacted by the pandemic and lockdowns, actually they would still be able to sort of very comfortably support the dividend sort of stream to investors. And the company has articulated that as and when they generate excess cash and the cash on the balance sheet builds up, if they haven't got sort of opportunities for acquisitions to deploy their capital, then they will pay special dividends to investors. So weighing all of that up, we had the opportunity to buy in an attractive price into a business which was impacted short term a bit, but still had the capital on the balance sheet and the cash generation underlying to support the dividend payments. There's options for special dividends going forward. And then the final thing is that the whole sector is sort of going through a potential structural change in terms of its quality of earnings, because and moving from a transactional model to trying to sign up customers on a sort of ongoing subscription basis with this auto switching idea. And a number of the competitors are trying to do this, but we're not betting that is super successful, but there is good optionality and upside if they can successfully increase the penetration of that as part of their revenue mix, then that recurring nature revenue is higher quality and should lead to a positive re-rating for the company as well.
Well, Ken, that's been incredibly interesting. Thank you so much for your time.
Okay, thank you.
And if you'd like to know more about the Gresham House UK Multi-Cap Income Fund, please visit the website chelseafs.co.uk. And to stay up to date with all of our videos, please don't forget to like and subscribe below.